Hello, I'm James Pacholek from CMG Wealth Management. Thank you for taking the time today for this quarterly market update. Well, what a year we had in 2022. Last time we spoke in October of 2022, the S&P was down roughly 25% and the bond index was approaching 18%. We haven't seen anything like that ever. As I mentioned in the video, if the market were to close at that current level, it would be the first time ever that the broad-based index, the S&P, and the Wilshire Bond Index ended down double digits. The last time they were even both down single digits at the same time was 1969. So to recap, what caused this phenomenon? Usually there's a flight to quality when people pour out of stocks because of something that's imminent in the economy. The assets flow into U.S. Treasuries and bonds, a safe haven. It's almost like a seesaw. Stocks go down, the bonds go up. So why did bonds go down and not up? It is the unprecedented raising of interest rates to fight inflation that the Fed has done. Why are they fighting inflation? I just want to recap again the trillions of dollars in fiscal stimulus and the trillions of dollars in monetary stimulus. You have so much money out there chasing after so few goods. We saw inflation we haven't seen in over 40 years. So what's the Fed to do? They have to be very aggressive in their interest rates as they increase those to try to the unenviable task to cool inflation without toppling the economy. And it's yet to be seen if that's even possible. So how did we finish the year? Well, we finished down over 18% on the S&P 500 and between 13 and 14% on the Wilshire Bond Index. It was the worst year for a 60-40 portfolio, which is kind of the quintessential retirement portfolio. The average 401k Fidelity announced was down over 20%. And so it was definitely not a time to buy and hold. And it was definitely not a time to be in bonds. I want to reiterate that at CMG Wealth Management that it's impossible to time and get every wiggle out of the market. But we also believe that there are times, especially unprecedented times, when we see trillions of dollars of stimulus. We saw bonds go to their highest level, which means they were yielding at one point, the 10-year Treasury, less than 0.5%. Now, it could have stayed there for a while, but one thing's for certain, you can't go less than zero. At least that's what we think. And so at CMG Wealth Management, we saw the upside in bonds as being very little, if anything, but we saw the downside risks. That's why in 2021 and for most of 2022, we had such a very small bond allocation. In some cases, zero. However, I do want to point out that when we see these draconian moves, one side to the other, that's the time to take advantage of those. So not only did we get out of bonds, but then as we approached November of last year and we saw the Wilshire Bond Index down almost 20% at one point, we started to add to our bond positions. We started to buy back in. Now, we bought back in slowly, approximately 10%, and we are increasing that because history has shown when bonds take a beating like they did last year, then the same thing is true. The reversal will happen. At some point, we believe this year, the Fed will stop raising interest rates, and those bonds that lost so much value will come back up again. And we believe there's great opportunity in that, but opportunity that you have to invest in. So we are increasing our bond exposure right now, and we realize that most asset allocators, the big firms that are out there, many of the big three, they never sell their bonds. I had clients last year that were down over 20% in their managed portfolios because they held those bonds and they held international stocks and emerging market stocks and high yield bonds. We had zero exposure to those in our portfolio on purpose. But now the opportunities are looking greater for bonds. So we want to share with you the moves that we're making as we're making them and not just after we've made them. So we hope that the videos that we're giving you will be insightful to you. And let me also just share with you a brief outlook. We just experienced the last week the failure of the SVB Bank, the Silicon Valley Bank. It was a bank run that the feds had to come in and rescue. And the old saying is the Fed will raise interest rates until something breaks, and that's what broke. Why did the bank collapse? It's, again, these draconian moves that happen in interest rates that affect the underlying investments. So banks, they borrow short term and they invest long term. Those long-term bonds over a year ago look good, but after the Fed raised rates in a dramatic way last year, your short-term rates are now higher than your long-term rates. And so those investments go down. Those long-term bonds, even though they're in U.S. Treasuries, and if you hold them to maturity, they're going to mature back at par and the investor gets their money back. But when you're a bank and your depositors start to withdraw and you run out of your investments that are there, your reserves, you have to go and sell those long-term investments at a loss. And that's just something that cascades down and ends very badly. So what to make of it, we're not certain. Will there be contagion amongst the other regional banks? It's been an interesting few days. But that's why, again, we're looking at these opportunities, and our very large cash position that we're comfortable in today is serving us well. Our money markets are paying just over 4.5%. If the Fed continues to raise interest rates, there's no telling how much higher they can go, but we could be approaching 5% or even greater. So we're at a point right now at CMG Wealth Management where we're going to see how these things unfold. We're going to continue to add to our bonds. We believe this is a prudent and long-term investment, and we will get back with you with the results of this in future videos to come. We hope you'll share this video with any friends that you have out there could benefit from it. And always, as always, thank you for being a client of CMG Wealth Management. Take care.